got this little mountain to climb here. It almost looks like a sort of slight head and shoulders, and gone through this trend support, broken straight through it, but at the same time it's broken through a major support level, which would have been a resistance level as well. There is a level here, like a full-on support level here that it's sitting on. That is almost like a little red flag for me, so I traded out all my trades on Friday, except for those of you who don't know me, I'm Rob. For those of you who do know me, I am still Rob. It's Coffee with Rob. Always good to have coffee. I've been doing this for 34 years, a long time.
Hello ladies and gentlemen, and welcome back to the channel. If you've been watching the markets lately, you've probably noticed something exciting happening. After a period of uncertainty, you will see a strong rebound. The charts are looking green, investor sentiment is on the rise, and it feels like the storm has passed. For those of you who held steady or even bought the dip, congratulations. Your patience is likely paying off right now, but this is where the real work begins. A rising market is fantastic, but it also brings a crucial question to the forefront. What is the best way to manage these newfound gains? How do you secure your profits and make sure you don't give them all back when the market eventually corrects again? It's a common dilemma. You don't want to sell too early and miss out on further upside, but you also don't want to be too greedy and watch your paper profits evaporate. Today, we're going to tackle this exact problem. I'm going to walk you through several practical strategies for securing your profits in a rebounding market. We'll cover everything from classic techniques to more dynamic approaches, so you can build a plan that fits your personal risk tolerance and financial goals. This isn't about timing the market perfectly because, let's be honest, no one can. It's about making smart, disciplined decisions to protect what you've earned. So grab a coffee and let us dive into how you can lock in those gains and set yourself up for long-term success.
Let's talk about how you manage a trade, how you take your profit, how to secure your profits. Because what we do in the market is we're very quick to take a trade. We take this trade, so this is the Bitcoin trade that we've just taken a few moments ago. And what we tend to do is we tend to take the trade, put our risk in place, which is at the $259.87. It's actually a $250 loss because we manage our trade. You know how we manage the strategy. So by this point, you should know how we manage the strategy. And that is, in my case, I'm managing 1% per trade. So in this particular account, we're managing $250. We're saying we'll put our stop there. And then we say we want our target up here at the 125, the high. So we're looking for $680 profit on a $250 loss. We're not always going to reach that profit, number one. And number two, if this thing goes into green after it's been in drawdown for a while, and it goes into slight green, $50 profit, whatever you, the psychology and your impatience is going to say to you, take that trade, take that trade, take that trade. You're going to try and take that profit. Now all you have to understand is that trading is 50-50. Now all you have to understand is that trading is risky. 75% of leverage traders do actually lose money in the markets. And if you don't like losing money and you don't like risk, you probably shouldn't be trading. And on that point, on the 5-minute charts and the day trading, 99% of traders lose money. Now, I know that you think you're going to be part of that 1%, part of that 25% that are winning, but you have to understand that retail traders make up a minuscule amount of the market, and you have to understand that most traders lose money because we are so minuscule, and you're trading up against institutional money. And if you're a beginner and you're just starting out, why do you think that you're going to just walk into the market and suddenly make all the money?
First up, let's talk about one of the most fundamental strategies, rebalancing your portfolio. It sounds simple, but it's incredibly powerful. Imagine you started the year with a portfolio that was 60% stocks and 40% bonds. After this recent market surge, your stocks have likely performed exceptionally well, and now your allocation might look more like 75% stocks and 25% bonds. While it's great that your stocks have grown, your portfolio is now much riskier than you originally intended. You're more exposed to the stock market, which means a future downturn would hit you harder. Rebalancing is the process of bringing your portfolio back to its original target allocation. In this case, you would sell some of your outperforming stocks there by locking in some of those profits and use the proceeds to buy more of the underperforming asset, which would be bonds in this example. This does two things. First, it forces you to sell high and buy low, which is the golden rule of investing. You are systematically taking profits from assets that have run up and reinvesting them into assets that are relatively cheaper. Second, it keeps your risk level in check, ensuring your portfolio stays aligned with your comfort zone. You can rebalance based on a set schedule, like every 6 months or once a year, or you can do it based on thresholds, for example, rebalancing whenever an asset class drifts more than 5% from its target. It's a disciplined, unemotional way to manage your portfolio and a cornerstone of smart profit-taking. Now let's move on to a more active profit-taking strategy, the trailing stop-loss order. This is a fantastic tool for traders and active investors who want to protect their gains while still giving their investments room to grow.
You're going to try and click out and take that $50 or take that $100. It's actually a worse psychology than the psychology of stop or dollar cost average, or when it's in a loss or trying to double up. The worst psychology is when you're in a profit after you've been in that scenario and it's sitting in the profit, showing you a little bit of green, and you're thinking, ooh, I want that. I'll take that profit any day. And you don't want to do that. What you actually want to be doing is, rather than taking that profit, is the very simple process of, this is what I always do with my profits, is I'll wait for this to go into the green and to go about $150 into profit, $175, somewhere there. Then I'll say, why am I risking a $250 loss on that? Because that's effectively now a $400 loss. So what I'll do is I'll take my stop loss, simply move it up to cost. Move it up to cost, $5 in profit for costs, and say, there's my stop loss up at cost. So now this trade is completely free. Now, the way you have to look at a trade when you take a trade is, I've taken this trade, and this trade is now costing me $250. Write that money off. That money is gone. I'm going to lose that money. But then when it goes into a profit of, say, $150, instead of clicking out and saying, oh, take that profit and run, look at it as, I was risking $250. Now I'm going to take it up to cost, put it at zero. Now this trade's costing me absolutely nothing. Now this trade is completely free. Now I follow it up. Now let's say the trade goes above a level. It breaks through this trend resistance at $100. It's making me $300 profit, and it's looking really good. Now there's two things you can do here. You can be cautious, and you can take your stop loss up from cost, and you can move it up to, say, $150 in profit and wait and see if it continues up. Or you could do that, and you could double the trade, add to the trade, or add 25% or 50% to the trade. Make the trade bigger because it's breaking out. It's breaking to the upside. So you're looking at a better trade. So you could do that, or you could just be cautious and just move your stop loss up $150, $160 in profit. Now it goes much further up, goes to 115, close to 115. Now you're thinking, man, I need to take those profits. I'm like $500 in profit. I need to get out of here. No. Now what you do, you take your stop loss and you move it up. $400 in profit, $375, somewhere close by. And now my stop loss is right up there. I know I can still lose that money when it comes back, but who's to say it's coming back? It could be going all the way to 125. Now I'm following it up with my stop loss. I'm following this trade up. Now, if it breaks through the 115, you've got a choice to make. Again, just like you had a choice to make earlier on. And that choice is, do I add to the trade or do I just move my stop loss up? Now, at that point, with a breakout there, you could add to the trade again because you've got another level. It's breaking through that level and it's moving on further. So now you could say, I've got a new trade. I've actually got another third trade that I can take on this product. I'll add to the trade again and make the trade even bigger. If you've added to your trade here and added to your trade here, you could be sitting with, instead of a $680 profit, you could be sitting with a $2,100 profit with what started as a $250 possible loss if you've added to your trade. But if you haven't added to your trade, you're looking at a $700 profit. But when it gets to the $700 profit, do you click out? Do you say, well, that's me, I'm done, I'm going to click out of my trade now? No, you don't. You look at it and say, there's $700 in my pocket. I'm going to take my stop loss, move it right up to maybe $600 in profit and just see if it keeps on going, because it might just keep on going. And if it keeps on going, you just keep moving your stop loss up behind it. Same goes for if you've got 3 trades on now, and this is now making you $2,100. That doesn't mean now that suddenly you must click out because it's such a big win, because it would be a gargantuan win. Let's say it started at $25,000 loss, and suddenly that's a $700,000 win or something equally ridiculous. You don't want to be saying, oh, it's such a lot of money, I need to click out. What you want to be doing is just putting your stop loss up as close as possible, and then just keep on following it up, because it could go to 200,000. It's Bitcoin, for heaven's sakes. So all of these gurus and all of these crazy people out there are saying Bitcoin's going to 200,000, Bitcoin's going to 1 million. These are the things people are saying about this particular product, and now you're in. Why would you want to trade out at 125 with the possibility that it can go all that way? So at that point, then what you want to be doing is saying, I'm either adding to my trade if it breaks out of there, or I'm following it up and I'm following it all the way. And that's how you manage getting out of your trades. That's how you get out of your trades. The only time that you click out of a trade is, firstly, if you're in a loss and you don't like the loss is, it looks like this trade's gone invalid. It's not a great trade anymore. Let's just click out of it. Let's let it go. Those are the best clicks out of trades ever, because you're just taking small losses and throwing it in the bin. Get rid of it. The other time is if it's in a profit and you just feel like this trade's going nowhere. It's just milling around. It's doing nothing. It's wasting your time. It's costing you in fees. Let it go. Then, okay, sure, you can click out of it. Let it go. You're tired of it. That's another reason to click out of your trade. But other than that, there's no reason to click out of your trade. For example, I'm $4.80 in profit, $5 in profit. Let's click out and take the profit. No, you don't do that. Just leave it. Let it run. The whole point of your trade is you had a plan. You made a plan to trade. And in that plan, your plan or your strategy was, I'm going to risk 250. I'm going to make 700. That's my overall plan. The best laid plans of mice and men, they don't always work out. But you can try. And you can try and make it work out. And the best way to do that is to try and just follow your stops up. Trailing stop behind your price. Do the trailing stops manually if you can, and you will end up with a whole bunch of small wins, because there'll be many times where it comes back and takes you out for the smaller win. You just have to accept that. That's trading. You just put it in as experience, and you put it in your profit bag, and you say, well, at least I made a profit. And that's all about how you take your profits and how you secure your profits in the market. Quite easy, isn't it?
So what is it? A regular stop-loss order is an instruction to sell a stock if it falls to a specific price. A trailing stop-loss, however, is dynamic. Instead of setting a fixed price, you set a percentage or dollar amount below the stock's current market price. For example, you could set a 10% trailing stop-loss on a stock that you bought at 100 and is now trading at 150. Your initial stop-loss price would be 135. Now, here's the magic. If the stock price continues to rise to, say, $160, your stop-loss price automatically adjusts upward to $144, which is 10% below the new high. It trails the price up, but if the stock price starts to fall and hits your trailing stop-loss price of $144, the order is triggered and your stock is sold, locking in a significant profit. This method allows you to capture the upside while automatically protecting you from a major reversal. It takes the emotion out of the selling decision. You're not second-guessing yourself or getting greedy. You're letting a predetermined plan execute for you. It is an excellent way to ride a winning trend without giving back all your hard-earned gains when that trend eventually ends. Just be mindful of setting the percentage too tight, and you might get stopped out by normal volatility. Too loose, and you give back more profit than you'd like. Another highly effective strategy, especially for individual stocks that have seen massive gains, is to trim your positions. This is a bit different from rebalancing because you are not necessarily reinvesting the proceeds into another asset class. Instead, you're simply reducing your exposure to a single high-flying stock. Let's say you invested in a tech company that has gone up 200% in the last year. That one position might now represent a huge portion of your entire portfolio. This is what we call concentration risk. Even if you love the company and believe in its future, having too much of your net worth tied up in one stock is a risky game. The strategy here is simple. Sell a portion of your holdings. A popular approach is to sell enough of the stock to recover your initial investment. Once you've taken your original capital off the table, the rest of the shares you hold are essentially house money. This can be a huge psychological relief. You know that no matter what happens from this point on, you can't lose your initial investment in that trade. You can let the rest of your position ride, hoping for more gains, but you're doing so from a position of zero risk to your original capital. Trimming can also be done in stages. This systematic approach helps you lock in profits incrementally as the stock rises, reducing your risk while still participating in future growth. Let's discuss a strategy that focuses more on mindset than mechanics, setting price targets. Before you even buy a stock or an asset, you should have an idea of why you're buying it and what your exit plan is. Part of that plan should be defining what success looks like for that particular investment. This involves setting a price. Target a price at which you plan to sell some or all of your position. Your price target shouldn't be a random number you pull out of thin air. It should be based on solid research. Maybe you use fundamental analysis and determine a company's fair value is $120 per share, or perhaps you use technical analysis and identify a major resistance level on the chart. Whatever your method, the key is to define it in advance. When the market is surging and everyone is euphoric, it's easy to get caught up in the hype and abandon your plan, thinking it's going to go even higher. But having a preset price target acts as an anchor. When the stock hits your target, it's a trigger for you to reassess. You can ask yourself, has anything fundamentally changed about the company to justify a higher valuation? This discipline is what separates successful investors from those who ride the roller coaster up and all the way back down. Remember, you'll never go broke taking a profit. Having a clear exit strategy before you enter a trade is one of the most professional things you can do as an investor. Finally, let's talk about a slightly more advanced strategy, using options to hedge your gains. Now, options can be complex, so this is not for beginners, and you should definitely do your homework before trying this. But for those who are comfortable with them, they can be an incredibly effective tool. One common strategy is to buy protective puts. Let's break that down. A put option gives you the right, but not the obligation, to sell a stock at a specific price called the strike price before a certain expiration date. So if you own 100 shares of a stock that has run up significantly, you could buy one put option contract to protect that position. For example, if your stock is at $200, you might buy a put option with a strike price of $190. This acts like an insurance policy. If the stock price continues to rise, you've only lost the small premium you paid for the option, but you've captured all the upside. However, if the stock suddenly plummets to, say, $150, your put option allows you to sell your shares at $190, saving you from a $40 per share loss. You're effectively putting a floor under your potential losses while keeping your upside potential open. Another strategy is writing covered calls, where you sell someone else the right to buy your stock at a higher price. This generates immediate income from the premium you receive. It caps your upside, but in a market where you're looking to secure profits, that might be a trade-off you're willing to make. Again, these are advanced tools, but they offer sophisticated ways to protect your profits during volatile times. So, to wrap things up, we've covered a whole range of strategies to help you secure the profits you've made in this market rebound. We talked about the disciplined approach of portfolio rebalancing to maintain your desired risk level. We explored dynamic tools like trailing stop losses to protect gains while riding a trend. We looked at the simple but effective method of trimming oversized positions to take your initial investment off the table. We also emphasized the importance of setting predetermined price targets based on your research to avoid making emotional decisions. We discussed how to leverage dividends as a form of automatic profit-taking. And for the more experienced investors, we touched on using options like protective puts to hedge your portfolio. The most important takeaway is this: you need a plan. Don't let a green market lull you into complacency. The best time to think about your exit strategy is when you're not forced to. By combining some of these techniques, you can create a robust plan that allows you to lock in your hard-earned gains, reduce your risk, and continue to build wealth for the long term. It's not about being greedy. It's about being smart. Thank you so much for watching. If you found this video helpful, please give it a thumbs up and consider subscribing for more content on smart investing. I'd love to hear in the comments which profit-taking strategy you use or plan to use. Stay safe, invest wisely, and I'll see you in the next video.